Interest rates are one of the most powerful forces in our economy, yet they often feel mysterious. Let's start with a simple definition. An interest rate is the cost of borrowing money. Think of it as a rental fee for cash. When you take out a loan, you pay back the amount you borrowed plus an extra percentage. That extra percentage is the interest. On the flip side, when you put money into a savings account, the bank pays you interest. In that case, you are the one lending your money. These rates are not set randomly. They are a tool used by central banks like the Federal Reserve in the United States to manage the economy. Why should you care about these numbers? Because they affect almost every major financial decision you make. They influence the monthly payment on a mortgage for a new home. They determine the cost of a car loan. They change how much you have to pay on your credit card balance. Interest rates also shape the returns you get on your savings and investments. When rates are low, borrowing is cheap, which can encourage spending and business expansion. When rates are high, borrowing becomes expensive, which tends to slow the economy down to control rising prices. For businesses, these rates determine whether it makes sense to invest in a new factory or hire more workers. For the government, interest rates affect the cost of its own debt. Higher rates mean taxpayers end up paying more to finance government spending. In essence, interest rates act as the economy's accelerator and brake pedal. The central bank carefully adjusts them, hoping to keep the economy growing at a steady pace without overheating or stalling. Understanding this fundamental concept is the first step toward answering our big question. The dream of returning to the ultra-low rates we saw just a few years ago is on many people's minds. But that era came to an end for specific reasons. To figure out if we are heading back there, we must first understand why we left. Not too long ago, the world of interest rates was remarkably calm, predictable, and low. For much of the decade following the 2008 global financial crisis, central banks, led by the U.S. Federal Reserve, kept their main policy rates pinned near zero. This was a deliberate strategy. The global economy was still healing, struggling with sluggish growth. The prescription was to make money as cheap as possible to encourage borrowing, investment, and spending. This era of easy money had a profound effect on everyone. For homebuyers, it was a golden age. A 30-year fixed mortgage could be secured for around 3%, turning the dream of homeownership into a reality for millions. But this cheap money had a flip side. Savers who put money in a bank account saw virtually no return. In fact, after accounting for inflation, their savings were often losing purchasing power. This pushed many to seek returns in riskier assets, like the stock market, fueling a long bull run. Low rates became the bedrock of the financial landscape. Businesses built their models around the assumption of cheap credit, and consumers grew accustomed to low-cost loans. The housing market in particular was supercharged. Rock-bottom mortgage rates fueled intense demand, leading to bidding wars and soaring prices. It felt stable, almost permanent. The idea of a significant rate hike seemed like a relic of a bygone era, a distant threat with little relevance to everyday financial life. Then, in early 2020, the COVID-19 pandemic brought the global economy to a screeching halt. Streets fell silent, businesses shuttered, and a chilling uncertainty gripped the world. Faced with the prospect of a depression, central banks acted with breathtaking speed. They dusted off the 2008 playbook and amplified it. The Federal Reserve immediately slashed its key interest rate back down to near zero. But they went further, launching colossal bond-buying programs, a policy known as quantitative easing, or QE. This meant creating new money to buy up government debt, injecting trillions of dollars of liquidity directly into the financial system. The goal was simple and urgent: to prevent a catastrophic credit freeze and ensure money kept flowing. This was a whatever-it-takes moment on an unimaginable scale. The immediate effect was to push borrowing costs to unheard-of lows. For a brief, surreal period, it seemed the era of cheap money was not just continuing, but entering a supercharged new phase. Mortgage rates plunged to historic depths, with fortunate borrowers locking in once-in-a-lifetime rates below 3%. And it wasn't just the central banks. Governments joined in with enormous fiscal stimulus packages, sending direct payments to households and rolling out aid programs like the Paycheck Protection Program to help businesses. This two-pronged assault, rock-bottom interest rates and trillions in government spending, was designed to build a financial bridge across the economic chasm created by the pandemic. And it worked, successfully staving off a prolonged depression. But this emergency medicine came with a powerful, delayed side effect. The economic recovery when it came was unlike any other. Fueled by stimulus checks and pent-up demand, consumer spending roared back. But people couldn't spend on services like travel, so they bought electronics, furniture, and home improvement supplies. This created a massive surge in demand for physical goods. The problem? The supply side of the economy was broken. Global supply chains were in chaos. A single COVID case could shut down a port. Factories operated at reduced capacity, and a global shortage of semiconductor chips hobbled car production. Suddenly there was a colossal amount of money chasing a limited supply of goods. It was the textbook recipe for inflation. At first, policymakers, including the Fed, believed this inflation would be transitory, a temporary blip caused by the unique frictions of reopening. They assumed that as supply chains untangled, prices would naturally come back down. That assumption proved to be spectacularly wrong. The price pressures weren't temporary, they were broad, deep, and persistent. The historic mismatch between supercharged demand and crippled supply ignited the most significant surge in inflation in 40 years. The very tools that had saved the economy from collapse were now overheating it, fueling an inflationary fire that would soon spiral out of control. By late 2021 and early 2022, it was clear that high inflation was not going away on its own. The word transitory was quietly retired from the vocabulary of central bankers. The Federal Reserve and its counterparts around the world had to make a dramatic pivot. Their primary mandate is to maintain price stability, and with inflation running far above their 2% target, they had no choice but to act forcefully. This meant using their main tool, raising interest rates, and they did so with historic speed and aggression. The era of easy money was officially over, and a new era of monetary tightening had begun. The Fed began a series of sharp interest rate hikes, starting in March 2022. It raised rates at the fastest pace since the 1980s. The goal was to make borrowing more expensive, which would cool down demand across the economy. Higher rates would discourage consumers from taking on new loans for cars and home renovations. They would make it costlier for businesses to invest and expand. The logic is straightforward. If you make money more expensive, people and companies will spend less of it. This reduction in overall demand is intended to give the supply side of the economy a chance to catch up, thus easing the pressure on prices. This aggressive action had immediate and widespread effects. The cost of a mortgage, which had been below 3% just a year earlier, soared to over 7%. The housing market, which had been red hot, quickly cooled. Sales activity slowed dramatically as potential buyers were priced out by the combination of high home prices and high mortgage rates. The stock market also stumbled as higher rates made safer investments like government bonds more attractive. The entire financial landscape was repriced for a world with higher interest rates. It was a painful but necessary medicine to combat the disease of inflation. As of today, September 6, 2025, we are living in the aftermath of that campaign. The Federal Reserve has successfully brought inflation down from its peak, but it has not yet returned to the 2% target. The central bank has held its key rate at a high level for some time now, waiting for more conclusive evidence that the inflation battle is truly won. This is the crucial context for our question. The high rates we have today are a direct consequence of the fight against the post-pandemic inflation surge. For anyone who started paying attention to finances in the last 15 years, today's interest rates can feel shockingly high. If your entire experience of borrowing money, whether for a house, a car, or a business, was shaped in the post-2008 world, the current landscape is a rude awakening. A mortgage rate of 6% or 7% seems astronomical compared to the 3% rates that were common just a few years ago. That difference can add hundreds, even thousands of dollars to a monthly payment, drastically altering affordability. However, it's essential to look at the bigger picture, to zoom out from our recent experience and place it within a much broader historical context. From a longer historical perspective, the rates we have today are not unusually high. In fact, the period from roughly 2009 to 2021 was the anomaly. This era of ultra-low rates was a direct policy response to the great financial crisis of 2008, an emergency measure designed to stimulate a deeply wounded global economy. That decade of near-zero interest rates was the exception, not the rule, in modern economic history. If we look back to the 1990s, a decade of strong economic growth, technological revolution with the rise of the internet, and relatively stable prices, the picture is very different. During that time, the average 30-year mortgage rate was typically between 7% and 9%, and yet homeownership expanded and the economy thrived. It was a period when the economy functioned quite well with what we would now consider high borrowing costs, partly because wage growth was also solid, helping to offset the higher cost of debt. Go back even further to the early 1980s, and the numbers are truly staggering. The US was in the grips of runaway inflation, and the Federal Reserve, led by its determined chairman Paul Volcker, was forced to take drastic action to break the inflationary spiral that was crippling the economy. At that time, to curb inflation, the Fed hiked its policy rate to over 20%, pushing mortgage rates to a peak of over 18%. Imagine financing a home at that rate. In that context, a 7% rate, while painful compared to recent years, seems quite manageable. This historical view is comforting, but what matters now is the future. So where are rates headed? When it comes to predicting the future path of interest rates, there really is no crystal ball. Economists themselves are, well, pretty divided, engaging in one of the most critical debates of our time. Still, we can identify a general consensus that's forming based on current data and long-term trends. The overwhelming majority of experts do not expect a return to the ultra-low 3% mortgage rates anytime soon. That world, they argue, is gone for the foreseeable future. While they do anticipate that central banks will begin to cut rates from their current peaks, the landing point is expected to be significantly higher than where we were before the pandemic. The goal is to find a new neutral rate of interest, a level that neither artificially boosts the economy nor holds it back. The big question is, where does that neutral level now lie? The idea of a higher for longer interest rate environment has gained significant traction. This camp, which currently represents the majority view, argues that fundamental structural changes in the global economy will keep rates elevated for years to come. First, there's deglobalization. For decades, the world pursued efficiency above all else, creating long, complex supply chains to find the cheapest labor and materials. Now, driven by geopolitical tensions and the painful lessons of the pandemic, countries are focusing more on resilient domestic supply chains. This process of reshoring is inherently inflationary, as security and redundancy are more expensive than pure efficiency. Furthermore, the massive investment required for the green energy transition will increase demand for capital. The shift away from fossil fuels requires trillions of dollars to build new infrastructure, from solar farms and wind turbines to modernizing electrical grids. All this borrowing competes for a finite amount of money, pushing up the cost of borrowing for everyone. Demographics also play a crucial role. For years, the savings glut from aging populations in countries like China and Germany helped keep global rates low. But now, as the massive baby boomer generation in the West enters retirement, they are starting to spend their savings. This shift from saving to spending could reduce the global pool of capital. Add to that soaring government debt levels, which also soak up savings, and you have a recipe for scarcer, more expensive capital. On the other side of the debate, a smaller but vocal camp of economists believes that the powerful, long-term forces that kept rates low for a decade have not really gone away. They argue that the higher for longer narrative is overblown. They argue that aging populations in advanced economies will still lead to higher savings rates overall, as people plan for longer retirements. More importantly, they point to technological innovation, especially in artificial intelligence, as a powerful deflationary force. By boosting productivity, automating tasks, and optimizing business processes, AI can enable economic growth without stoking inflation, allowing central banks to maintain lower rates. In this view, the recent inflationary spike was more of a one-off event, a perfect storm caused by the unprecedented supply chain disruptions of the pandemic colliding with a massive simultaneous fiscal and monetary response from governments worldwide. Once these unique effects fully fade from the system, they contend, we will return to the pre-pandemic environment of secular stagnation, characterized by low growth and low inflation. This, in turn, would naturally lead to a return to lower interest rates, even if they don't hit the rock-bottom lows of 2021. So, who is right? While economists debate, data from financial markets provides a real-time gauge of these expectations. The pricing of long-term bonds and derivatives, where investors bet trillions of dollars on the future path of rates, suggests that the market is betting on rates coming down from their current highs. However, the crucial detail is that they are expected to settle in a range well above the pre-pandemic levels. The market is not pricing in a return to the world of near-zero interest. For example, current market pricing might imply a long-run Federal Reserve policy rate of around 3 to 3.5%. After banks add their typical spread to cover risk and profit, this would likely translate to mortgage rates in the 4.5 to 5.5% range. While this is certainly a relief compared to 7%, it is a far cry from the sub-3% world of 2021. The era of free money appears to be over, replaced by a new normal, where capital once again has a meaningful cost. To truly understand where rates might be headed in the long run, we need to look beyond the day-to-day noise and focus on the deep, underlying economic drivers. One of the most important, yet elusive concepts that central bankers and economists grapple with is the neutral rate of interest, often called R* or R. Think of it as the Goldilocks rate for the economy. It's the theoretical interest rate that keeps everything just right. Economic growth is chugging along at its maximum potential without overheating, and unemployment is low, all while inflation remains stable and predictable, right at the central bank's target. It's the rate that neither stimulates nor restricts economic activity. So when a central bank sets its policy rate below R*, it's like pressing the accelerator, making borrowing cheaper to encourage spending and investment. Conversely, when the rate is above R*, it's like tapping the brakes. Higher borrowing costs cool the economy by making new projects less attractive and encouraging saving. The challenge is, no one knows R*'s exact value in real time. It must be estimated. A key debate now is whether this invisible rate has fundamentally shifted higher. For years, economists believed it was falling due to forces like demographics, an aging population saving more for retirement. However, the post-pandemic landscape may have changed this. Increased government spending and debt creates more competition for capital. A surge in investment demand for new technologies and green energy requires it, and a move towards more resilient but less efficient global supply chains also demands massive spending. These forces could be pushing the neutral rate higher. If the neutral rate is now higher, it has profound implications. It means the new normal for interest rates, from central bank policy to your mortgage, will also be structurally higher just to keep the economy in balance. Inflation expectations are another critical driver. If people and businesses expect prices to rise, their behavior can make it a self-fulfilling prophecy. Workers demand higher wages, businesses then raise prices to cover costs. This can create a wage-price spiral, making inflation much harder to control. This abstract world of economic policy has very real consequences for your personal finances. The most direct and powerful impact of rising interest rates has been on the housing market, which is exceptionally sensitive to borrowing costs. For a potential homebuyer, the difference is enormous. On a $400,000 30-year mortgage, a 3% rate means a monthly payment of about $1,686. At 7%, that same mortgage costs $2,661. That's nearly $1,000 more every month for the exact same house, a massive blow to affordability. This has pushed homeownership out of reach for many and created a lock-in effect. Existing homeowners with ultra-low rates are reluctant to sell, freezing housing inventory and leading to a significant slowdown in home sales. The impact extends to all forms of debt. Auto loan rates have climbed, making cars more expensive. But the most immediate hit for many has been on credit cards. Their APRs are typically variable and tied to the Fed's policy rate. As the Fed hiked rates, interest on card balances soared to record highs, making it much more costly to carry debt. Variable rate borrowers have felt a direct hit to their monthly budgets. And this is precisely the intended effect of monetary policy: make borrowing less attractive, encourage saving more, and ultimately, encourage spending less to cool down the economy and bring inflation back to target. However, there's another side to the coin. For savers, higher interest rates are unequivocally good news. After a decade of near-zero returns, people can now get significant, safe yields from certificates of deposit, high-yield savings accounts, and money market funds. Savers once pushed into the riskier stock market can now earn a safe yield on their cash. This is especially welcome news for retirees and anyone relying on interest income. This shift rebalances a landscape long tilted toward borrowers. Ultimately, interest rates shape our financial behavior. Low rates encouraged risk-taking and spending. High rates are forcing a great reset, leading to saving, caution, and a focus on fundamentals. The shift has been a shock for households and businesses accustomed to cheap money. Adjusting to a reality where borrowing has real costs and saving has real rewards is the central financial challenge today. Whether this new reality is permanent is the multi-trillion-dollar question. So, let's get to the bottom line. Based on the evidence and expert consensus as of late 2025, a return to 3% mortgage rates like 2020-2021 is highly unlikely soon. While not impossible far out, current economic forces point to a new normal of structurally higher rates than the post-2008 decade. The unique combination of global pandemic, massive government stimulus, snarled supply chains has reset the economic landscape. The primary reason, the ongoing battle against inflation. Inflation has cooled, but central banks will stay cautious. They can't cut too aggressively and risk inflation flaring up again. That would damage credibility and force higher hikes later. So, rate cuts will be slow and deliberate, only when price stability is certain. That makes a rapid plunge back to ultra-low rates very improbable. Beyond inflation, structural shifts suggest a higher baseline for rates. Move away from globalization, huge capital needs for the green energy transition, higher government debt levels. Many economists now think the neutral interest rate is higher than before the pandemic, meaning the long-run baseline will be above the near-zero levels we got used to. Final answer: clear, but disappointing for hopeful borrowers. The 3% mortgage was a product of a very specific, unusual period, a golden era for borrowing that's now behind us. More realistic, mortgage rates settling around 4.5% to 6%. Still better than recent peaks, but a decisive end to ultra-cheap money. Adapting to this new reality, more expensive borrowing, more rewarding saving, is the key task for households and the economy. Remember, from a historical perspective, these rates aren't extreme. The 1990s economy thrived with mortgage rates between 7% and 9%. Markets and consumers will adapt, new financial products will emerge, different strategies will develop for this environment, and let's not forget, millions of savers and retirees are finally earning meaningful returns on their money for the first time in over a decade. This rebalancing toward rewarding saving and making borrowing more thoughtful may actually create a healthier, more sustainable economy in the long run. So while the dream of 3% mortgages may be over, the new normal doesn't have to be a nightmare. It's simply a different economic landscape, one that requires new strategies but still offers opportunities for those who understand it. The era of ultra-low interest rates was extraordinary, but it was also extraordinary for a reason. As we move forward, understanding these new realities will be key to making smart financial decisions in a world where money once again has a price.